Hello everyone, this is Igor Pechkovsky with Windermere Bellevue Comments, and this is my dear friend Jim Murphy with Movement Mortgage. You are here in another episode of Between Two Ferns, but jokes aside, if you've been to our channel, we do like to crack some jokes and talk about economy and serious things. But when things get too serious, when I understand something, but I'm too lazy to explain, I have Jim here today with us. And we're gonna talk about the Fed's policies of increasing interest rates and how they impact the real estate market and why a few banks have failed in the way and what can we all do about it and maybe expect. So with that being said, let's have some fun. We'll have a little and a lot of great information today, and let's get started. All right, so the first slide that you see, I think before we can talk about the banking system and what had happened, it's really good to understand of kind of in a nutshell, in super basic and simplified way, how does this work?
Yeah, so the banking system basically works as you, the consumer, deposit money to the bank, right? And they're gonna give you maybe a 0.5% return by holding your money. And it's always funny when you look at your statement that says you got 16 cents this month. So when you do that, all of a sudden the bank turns around and takes your money. They only have to hold like 10 to 15% of your deposits. So let's use $100,000 as an example. Maybe they only hold 10 to 15,000 of that. The other 85,000 in that scenario, they go and they use your money to then basically get a bigger return. They'll find things like a CD or maybe it's a bond market, something like that that's relatively safe. They can get 2 to 3% return. They'll pay you the half and make the spread. So basically, they're using your money to make money, and they're giving you a portion of that throughout the entire year or quarter, however long you have that money in there.
And that's really good business model, because even if you fail, the Fed will bail you out. So we're in the wrong business, buddy.
Technically, yes, they did that.
All right, let's go next. So with that being said, I guess we have a really good slide here. Fed was begging for inflation 2021. That's kind of a good looking slide.
It's a nice slide. So let's explain it. So that little gray chart that you see is basically 2020, like the start of COVID. And that's basically showing what we really thought was going to be a recessionary time in 2020, especially after COVID hit. We then see the bottom portion that says quantitative easing. What that means is the Fed dropped money down to zero, and they were putting money into the marketplace in stocks, bonds, basically anything they could get their hands on to keep an economy generating while you had so many people at home. And when they did that, frankly, they just did it too long. It worked during 2020, but in 2021, they should have stopped it. They didn't. They did it all the way through in basically March of 2022, and then you saw interest rates rise. What they were hoping for is to slow down the velocity of money. Because if you have a 0% interest rate, everybody saw this on cars and home equity lines, all those different things, you go out and buy more. And people bought so much during 2020 and 2021 because the savings accounts were so high that you could borrow money at basically zero, that the Fed had to raise their policy up from basically 0 to 5% in 14 months. That's the fastest that's ever happened. And that is a crazy change in a very short period of time. What that did is make those same things way more expensive, right? Like your home equity lines went up 4%, your car loans are now in the 4s and 5s instead of 0s and 1s, and even like credit cards are from like 18% to 25%. That's what they're directly impacting is personal lines of credit. So what the Fed did is raise things so quick so that they could kind of halt how fast people were spending money and buying things.
To summarize what Jim just said, technically, when COVID started, we printed a lot of money. We dropped the borrowing, rates to zero, the federal rate between the banks, and everything just went bananas from there. And
you have to remember too, right? The banks borrow money from the Fed at zero, then they can give it to you at their margin, and their margin's about 1/2 to 3/4. So when you saw those 0.99%, car loans, those 0.99% car loans were borrowed from the Fed at like 0.25%. Now they're borrowing money at 5%, so those 0.99 car loans no longer exist because the money's not that cheap anymore. And
yeah, so everything was bananas, and they pretty much went up and jacked the rates really quick. And what did that do?
That basically put the banks in a position where, as a consumer, you now have more options. So, for instance, that 0.5% return that you used to get in your savings account, there are very easy options to get 3, 4, 5, 6, 7% returns over a certain amount of time. Like a 6-month CD right now is probably somewhere in the mid-5s to 6% return. Why would you have your money in a savings account at 1/2 when you can go turn around and pull it out and get it for 6? So that's basically what caused these banks to go under, is all the consumers came out and said, "No, give me my money. I'm going to go to this direction instead." And at the same time, people that had stock in those companies saw this happening and shorted those stocks and then pulled their money out of stocks, which pulled money and investments from the companies as well, because they could no longer go back to their stock and sell it to get money to give to consumers. And ultimately, that just failed 3 massive banks. Those are the second, third, and fourth largest banks to die since 2008. Like, it was $500 billion in assets. That's insane. That's more than like 511 banks that failed since 2009. I mean, it's a huge dollar amount.
So what you're saying is the people just showed up and said, "Give me my money, baby.
100%.
I'm gonna go put it elsewhere," and there was pretty much no money to give. And
go watch It's a Wonderful Life if you've never seen it. It's a classic run on the banks. That's literally what it was. I want my money now, and they didn't have it. It was that simple. They already spent it different directions, because when they took your money 2 years ago, they invested in 2 to 3 year asset classes that were going to then give them that money over that period of time, because they don't have to hold your $100,000. They only have to hold 10 to 15. So that $80,000 is no longer at that bank. It's in a different depository, making how they make money. They're making their 2 to 3%, but the problem now, that 2 to 3% is 2 to 3% lower than what you can get in today's rates, but they already invested in it 2 years ago. You can't just stop your investment. So it was crazy. The consumer can now get it better. The banks already spent it, and now you want it, but they don't have it because it's somewhere else. So they said, "Oh God, we don't have money anymore." And then basically the Fed came in and said, "Okay, we'll take care of this. Consumer, take your money. Bank, you can then get purchased by somebody else." And now, like Chase, for example, just bought First Republics last week at a significant discount, and they also will just hold those assets as long as they need to. In short, they bought a regional bank for very cheap. And that's going to keep happening over and over again. That's why regional bank stocks in general are down 40% for like the last 6 months.
Interesting stuff.
Wild.
All right, guys. So I know that was a lot. Be with us. Let me just ask you this. So what does this whole thing means, right? Let's summarize. And do you think other banks could be like affected by it?
I think they could. We've seen 3 really big banks go down. Like I said, there's 2, like the second, third, and fourth largest banks since 2008. And I don't think it's a cause for crisis and a cause for concern, but what it's going to do is you're going to take the super banks, like the too big to fail banks, Chase, B of A, Wells Fargo, all these massive banks, they're going to absorb more regional banks. And I don't think this is the last one that we're going to see go under, but it's honestly too early to tell, right? It's kind of, oh wait, it went under today. You don't really get a warning on that.
But also a good business. So big banks become bigger by eating smaller banks in default. Huh?
Yeah, it's interesting. So it's almost like the big guys are eating the small guys right now because they have enough assets to do it. And the regionals are having a tough time performing because they just simply don't have as big a balance sheets to offset big losses like that. And it's going to be interesting to see if that continues. I think it probably will. I think you've seen the worst right now, and it'll be interesting to see what the Fed does to pivot on that. So far, they haven't really mentioned it, which is shocking because they're a major contributor to these banks going under.
Well, Jim, then let me ask you my final question. We'll wrap up on this. So you just mentioned the rates. So is there a chance for the Fed to pivot on their strategy? Because I assume they keep raising rates because they can, right? Like that, they think that they can.
You think that they can, and
but
really,
at some point they should pivot.
You feel like they'd have to stop at this point, right? They kind of already put into mention that they're going to take a pause and see what happens. And the timing's interesting because we're going to start to see some lagging economic indicators that are going to bring inflation down. I've read articles that most people think if you just pulled inflation today, it's probably in the mid 2%. It still says somewhere between 5 and 6, but realistically, if you pull out all the different factors that you're looking at, where the unemployment rate really is, where money really is trading, the job market in general, it's probably closer to 2 to 3%. And if you look at it from that perspective, if we do go into a recession because of all of this, which is kind of where things are starting to head, you should see the Fed pull back on that. And as soon as you see them lower the cost of money, you're going to see the very similar thing to 2020, where you saw stocks perform well because they're, again, buying money more inexpensively or borrowing money more inexpensively from the Fed. So as soon as you start seeing that go the opposite direction, you should see a velocity of money start moving around again.
Interesting. So with that being said, guys, right? because they're hiking rates right now, but one beautiful day through 2020, they just came out to the presentation and they dropped the rates, like we call it a big bazooka, right? Like Fed's bazooka, and the rates just went to zero overnight pretty much. Can they do it? They can. The question is like, how much more pain will they, you know, sustain on all of us in different businesses? But I don't think it might go to zero. I don't personally think that the market would be as insane. You know, buyers learned kind of that the market can keep going up. The sellers might be a bit more reasonable because they thought that it would never end. Sellers got quite a bit greedy. Let's just be real.
Definitely.
But overall, it will prompt the markets. I believe so too. I mean, it's all about the price and the rate, right? Like the higher the rate, the lower the price when the rates change. Or I think ideally if they'd be around 5%, I'm happy with 5%. I think it'd be amazing.
Yeah, so I mean, two different things, right? So the Fed funds rate is different than mortgage rates. You know, mortgage rates track inflation. So, you know, when we do see inflation come down in the next, we're hoping this week we're going to get some good results here mid-May. We also think we're going to get better results in June, July, and August. So most economic forecasters are predicting mortgage rates in the mid to low fives by the end of the year. I think the Fed pivot would be holding or lowering their cost of money. And I think that could happen a lot sooner than people thought originally, because I think you're going to see a lot of, you know, and this bank failure stuff is a huge part of it. If you continue to see that, they're going to have to lower the Fed funds rate, or you're going to see, you know, too much damage. And right now, I think we're in a position to just kind of see what happens in the next 60 days. But I do think mortgage rates come down. And as soon as you see a 5 in front of that, you're going to see more buying velocity, that's for sure.
Well, guys, to wrap it all up, I know it's a lot, but I've been having people ask me those questions all the time. I felt like, hey, let me just have a person that knows a few things about it, so I don't have to mumble through it. So we have Jim. Thank you, Jim, for that.
Yeah,
and I always would say, you know, to buyers, to sellers, it's all about your personal timing, right? Like for the buyers, if you can find the place that you can afford and you like, and you could see yourself living into it, do it. If you can afford 7% interest rates and you can still find a good home, I think it makes sense, because just like we just discussed, the rate change, it's a matter of when, not if. When things go really, really bad, the rate will change. Or if things will go slightly bad and things will go slightly better, right? The rates can stop at 5, so you could refinance, but you cannot change the price. So if today's prices make sense to you and you could do it, I would do it. And as long as the payment is comfortable for you, as long as you like the place, that's the way that I would look at it.
Yeah, totally. And there's a lot of mortgage options out there that you can look at, right? Like ARM rates, permanent buy downs, 2-1 buy downs. There's all sorts of stuff you can look at to try and make the home as affordable as possible. But you know, just in this whole economic climate, I think the biggest takeaway for me right now is something is going to change as far as rates go from the Fed side and from the mortgage side. So you know, it's an interesting environment. I think you're going to see a lot of changes pretty quick.
Thank you, brother. All right.
Anytime.
You guys tune in, like it. Even if you don't like it, still like it and send it to your friends, and put a comment how you disagree with us. Appreciate you all. Till the next time. Bye.